Hi. In this lecture, I want to talk about something called the normal random walk model. And the idea here is that we've got a random walk just like we had previously, except for now instead of the steps being +1 or -1, they can be any value, and those values are going to come from a normal distribution. What I'm going to do is I'm going to use this model to talk about something known as the efficient market hypothesis. And the idea behind the efficient market hypothesis is that market prices capture all available information. And if that's true, any fluctuations in the price would be random. And so therefore stock market prices will be just a random walk. Now, of course, if stock market prices should be going up at some rate that's proportional to the growth of the economy, but after we detrend it, what's left should basically just be random, a random walk. So first let's talk about random walks, and then let's think about this efficient market hypothesis. So here's how a normal random walk works. You basically, again, just like before, you set x equal to 0, and then each period you change the value by some random amount, but that random amount comes from a normal distribution. So instead of x going to +1 or -1 next period, it might go to +3. And then the next period it might go to -1 if I get a really bad shock. So you think of there's shocks that drive it up and down, and those shocks come from a normal distribution. So if I look at a bunch of normal random walks, I get a picture that looks something like this. Some of them end up really high, some end up really low, but on average, since the mean of the normal distribution was 0, we'd expect them to, if I added all these things up, to be right about 0. So there'll be big winners, big losers, but things will come up pretty much right about 0. Now those step sizes, and this is the important part, I'm going to assume come from a normal distribution. And when you think about the idea of that prices in a stock market are a random walk, you could also use a normal distribution, but that's not quite accurate. In fact, if you look at returns on the Dow Jones Industrial Average, you'll see that it's not quite normal. There's more days where nothing really happens. There's also more days where there's really big events. So there's sort of fewer moderate days. So you get surprisingly large events, surprisingly small events, and you get a lot of zeros. But it's not a bad first approximation to think of it as a normal random walk. But we could fix it to approximate the normal exact distribution if we wanted. Now, there's a famous book by Burton Malkiel called A Random Walk Down Wall Street. And what he argues is that prices in the stock market are random walks. Now, you might say, well, that's crazy. No, there's trends. There's things that go up and there's things that go down. Well, let's look at some data on that. So suppose the Dow Jones Industrial Average posted a gain the previous day. If there really were trends, you'd expect there to be a gain the next day. Well, here's a graph that shows whether or not that's true. Now, if you look, here's the 50% mark. So if Malkiel's right, you'd expect to see no trend, that if it's high yesterday, it's not necessarily going to be high today. And if you draw a line like in 1975 and look past there, you see that's pretty much true. Now, prior to 1975, it wasn't true. So what you could argue is the markets maybe have become more efficient. There really is no advantage there. But this makes sense. Because think about it. Suppose it were the case that if prices went up today, they were going to go up tomorrow. Well, what should you do? You should bid even more today because you're going to make money tomorrow. But if you bid even more today, that's going to drive prices up today, which means that they won't go up tomorrow, which means that Malkiel's right, they're probably going to be random tomorrow. So any trend, people should anticipate. So here's the efficient market hypothesis in short form. Prices reflect all available information. Therefore, any fluctuations should just be random because it's impossible then to beat the market. Here's sort of the long version. The efficient market hypothesis is associated with the idea of a random walk. And this is a term usually used in the finance literature to characterize a price series where all subsequent price changes represent random departures from previous prices. The logic of the random walk idea is that the flow of information is unimpeded and information is immediately reflected in stock prices. Then tomorrow's price change will reflect only tomorrow's news and will be independent of the price changes today. But news is by definition unpredictable, and thus resulting price changes must be unpredictable and random. So what does this mean? This means that the stock market is containing all relevant information. So if there was any information that you could use to make money, somebody else could use it to make money, and it would already be in the price. So for example, suppose that somebody invents a new drink that uses oranges, and you know this is going to be wildly popular. So therefore the price of oranges should go up. That means if the price of oranges is here and you know it's going to go here, you should buy oranges and you're going to make money. However, other people know that as well. If all information is out there and it's unimpeded, everyone will know that the price of oranges is going to go up, and so the prices of oranges will immediately be driven up. So therefore, any changes in the price of oranges tomorrow are going to be random. There will be no trend towards oranges reaching this price. They'll immediately jump to what their full information value will be. So what we get is that stock market prices should be random. Now, you could say, is that true? I mean, we saw the one graph, but I mean, let's look more deeply. Well, one thing that people noticed was something called the January effect. And if you looked at what happened to stock prices from 1927 to 2001, you see, wow, in January, stock market prices went up 4%, whereas in the other months, they went up less. What does this mean? It means, like, boy, it's really good to invest in December. Invest in late December, you'll make more money. Well, if everybody knows this, then what should happen? They should all invest in December. Prices will go up in December, which means prices in January will go down. So let's look in 2009, and let's look at what happened in the month of January. Well, what do you know? It went down. Let's look at 2010, 2011. Now here is January right here, and what we see is, again, it went down in both cases. So if you think about any trend that might exist, any inefficiency in the market, once you identify it, other people should identify it, and therefore you're not going to be able to make any money. Now, if you're the first mover, you can make some money. If you're the first person if you're the first person to learn about orange prices is going to be higher, yes, then you'll make some money. But in general, if you just look at the market, you shouldn't expect any systematic trends. You should see what's a random walk. Now, of course, people are critical of this. There has to be something wrong with that theory. So let's look at some of the criticisms of the efficient market hypothesis. Here's the first. There's way too much fluctuation. So this is just the price of Starbucks stock. And this is just, year by year. And if you look at the fluctuation in any stock's price, it just goes up and down so much. It's really hard to believe that the prices are really efficient. There must be other stuff going on. Here's another problem. There's consistent winners. If it were the case that things were efficient, then we wouldn't have anybody win 30, 40 years in a row. Somebody might win 10 years in a row, but people wouldn't win 30, 40 years in a row. And you wouldn't see people who systematically outperform the market at the level at which you see in real data. So this is Berkshire Hathaway, Warren Buffett's company. What you see is they've so consistently outperformed the market that it's really hard to believe that that's luck. Okay, so what have we got? We've learned that we can write down a very simple normal random walk model. And with that model, we can engage something known as the efficient market hypothesis. Maybe you believe it, maybe you don't, but it's a reasonable model to think about what stock prices look like. And if you fit it to the data, you see in some cases it seems to work pretty well. And in other cases, maybe there are some consistent winners, maybe there is a little bit too much volatility. It doesn't quite work. But it's still the case that the model helps explain a little bit what stock market prices look like. And it's also a reasonable model to apply in a whole bunch of other situations as well. Thank you.